Uh, Welcome, everyone. I'm Krishna. I'm the founder CEO of Fiddler. We are here on the AI in Finance Summit on a session on considerations around risk management around AI and how do we use responsible practices in AI. We have a fantastic panel that is here to discuss this topic, starting with August Sudianto, the Executive Vice President and Head of Model Risk at Wells Fargo. August is one of the very respected XAI leaders in banking space. Welcome, August.
Thank you.
And,
Thank you.
and Tulsi Doshi, she's a product lead for responsible AI at Google. She is driving the product efforts for Google internal tools and Google products. Welcome, Tulsi. And we have Jacob Kosoff, who is the head of model risk management and model validation at Regions Bank. Jacob also writes a lot of articles in American Banker around model risk management and explainable AI. And then finally, we have Sri Krishnamurthy, as the CEO of Quant University. And Quant University is data science, machine learning, and quant analysis advisory firm. And they do a course on model risk management online if you want to join and learn more. Great. So with that, I'm just going to spend a couple of minutes to give an overview about Fiddler and what we are trying to solve. It's very relevant to the session that we are doing, and then we can dive deep into the panel's discussion. Give me 1 second. Awesome. We are an explainable AI platform startup at Fiddler. We started with the mission to build trust into AI, and as one may be seeing, as companies are adopting machine learning in a big way, they are running into this problem of machine learning models becoming a black box and not having proper visibility and monitoring and explainability. And we are seeing that it is starting to affect the data science teams building the models, but also the teams that work with the data science teams, the customer operations, the business users, the regulator, the risk management teams are having lots of questions around the models and how they're performing, why they're predicting what they are. And so this is some of the work that we happen to solve in our prior jobs, especially when I was at Facebook. I was leading a similar platform for newsfeed. And we worked on it from 2016 onwards to introduce more transparency into newsfeed AI and launch some internal and external features like, why am I seeing this post and why am I seeing this recommendation in your newsfeed? We are today working with some great partners in the industry, like AWS, Facebook, and a lot of financial services companies to introduce explainable AI and monitoring into their workflows, and have built a product that appeals to the machine learning teams. If you're sort of familiar with analytics tools like Tableau or Datadog, we have created a product specifically meant for machine learning teams to continuously monitor and explain their models so that they can have a certain system of record of what's going on with their machine learning and AI in production and why is it happening today. So it's very simple to use. And if you are a machine learning engineer, you can just bring your model and data set into Fiddler and then start monitoring and explaining the models. So what we are essentially doing, this space is evolving. So we are doing a lot of webinars like this. We have done an explainable AI summit earlier this year with top leaders from conferences. We were also publishing papers, and we are very excited to share more around this topic today. If you're interested to learn more about Fiddler, you can log into our website at www.fiddler.ai, and there is a free trial that's happening if you're interested to sort of participate. With that, I'm just gonna give it to my speakers, starting with August. August, perhaps could you just give us an overview of model risk management in banking, since you've been working on it for a long time, and how does this process work? Who are the stakeholders? And what is the reason this process was introduced in the first place?
Well, the Bang we use a lot of models. So in Wells Fargo we have a couple thousand models that we deploy. So we run banks with models. So that's what we have. And with the complexity that we deal with, we have to really manage because we believe all models are wrong. And when they're wrong, they create harm to the institution, be it financial harm or non-financial harm, be it to the institution or the user or the customer. So we have to build model very carefully, test model very carefully before deployment, and then once you deploy, when you deploy the model, that's the life of model began, right? So the monitoring, understanding how the model will be wrong, how this performs, very critical, particularly for machine learning, because machine learning is very flexible model. Once you retrain it, the model basically completely changes. So you need to know what's going on, how the model will be wrong. So we've model safety, we call it, is a very critical component to in our space.
Awesome, that's great. So Tulsi, you have a very interesting background. You're working at Google, which is absolutely known for cutting edge AI products like search, ads, and so many other AI products that you deliver. How is Google, like a tech company, looking at responsible AI, and like where is it going within Google as per your understanding today?
Yeah, good question. So I think for me, and I think when we think about responsible AI at Google, right, I think the fundamental piece comes down to trust, right? So the whole goal of responsible AI is to build products that are safe for users, that work for everyone, and that users can trust. And so at Google, we actually have responsible AI principles that we put forward that range from focusing on being socially beneficial to thinking about scientific excellence to really calling out specific areas like fairness, privacy, accountability, safety, where we really want to make sure the AI that we're building upholds those principles. And we've built that into the review process that we have at Google for our products, but also into actually trying to proactively build that in. And that's the role that I play, is trying to figure out what does it mean to actually think about fairness in a search or in a YouTube or any of these spaces, and what does that look like when we actually want to build tools to make that easier, right? How do we frame out these problems? And I think hopefully the more that we focus on that notion of trust and actually how that relates to all of these principles, that is how you get hopefully really excellent products and really good machine learning based systems.
Awesome. Yeah, that's great. We will dive into some of the case studies as the session goes on. It'll be very interesting to talk about them. So Jacob, model risk management, as far as we know, was introduced many years ago, right? And how is AI playing a role here? What is changing with respect to MRM as you see more and more models becoming AI and machine learning based in banks today? You're on mute, Jacob.
Okay, good question, Krishna. And I was going to show a slide to demonstrate a little bit of the evolution. But you mentioned I write some articles. I don't write as many articles as the Goose. They're more advanced, also more practical. So definitely encourage everyone to read the articles that Goose and his team at Wells Fargo have been producing. So I'll share a screen here about some of the evolution. And this is something we've shared with our board and we've shared with leadership. And so we listed on the left what the typical responsibilities were for model risk and the head of model risk at a regional US bank in 2011, and what the responsibilities are today at still at a regional US bank, but for 2021. And so the fourth row here is the head of model risk usually leads AI risk management. And so this really is key for our team to upskill, present guidelines, and ultimately train the rest of the bank around AI risk, around ethical AI, around model fairness, around transparency, and on and on. And there's related then risks. We provide more guidance on the use of models and how we test models in relation to open source libraries, models in the cloud delivered through APIs, and so forth. And so there's numerous changes going on in banking, and there's numerous, to Agus's point, banks are run by models, and model risk is just playing a larger role. You know, when I started at Regions, capital planning was about 50% of all models, and now capital planning is about 20% of all models. So you can just see that the growth of everything else. And, you know, 30% of our models are machine learning models now. And so it's really important that the model risk teams are both adaptable, but also can be leaders and thought leaders and continuously guide and challenge the line of business.
Awesome, that's great. You know, Sri, you're running this advisory firm, perhaps, you know, coaching institutions on how to employ MRM practices. As this new AI-based models are entering into banking industry, what are some of the skills that people should be equipped with, like, for example, data scientists or, you know, risk managers, to actually be able to validate and, you know, govern these models properly? Sri, you're on mute. Yeah, speakers, you can just be unmute yourself all the time. That way.
Oh, thank you. So as the profession of model risk management has gone beyond, you know, looking at traditional models, and now that we have a whole influx of newer models, right? So as Jacob was mentioning, we are looking at AI and machine learning kinds of models, open source libraries coming in. Most of these are like data-driven models. And the innovations in the Silicon Valley are now kind of knocking the doors of Wall Street, right? So we have TensorFlow, PyTorch, all those were things which we would look at as frameworks which are predominantly done for deep learning and autonomous driving kinds of applications. Now people are writing papers, people are looking at models on how we can bring them into the financial services industry. And what that means is when you look at the job boards of large institutions, and Agus and Jacob can attest, a lot of skills in the context of we require Python developers, we require people who have the background in data processing, machine learning. All these are skills which are required. And that brings an interesting question. You know, it's not only upskilling the quants who have traditionally been looking at statistical packages. Now, I came from the MathWorks world, you know, using MATLAB and building statistical models using MATLAB, but now we are building data-driven models. You have to think in a different way, and how do you validate these models? How do you build out different kinds of frameworks to look at whether the models are performant or not? So you can't just go back to the statistical theories. You know, not only you have to kind of think beyond the statistical theories. And what that means is model risk management teams who are going to be validating should have both the contextual knowledge of like what's actually being developed, but also have the knowledge to think about introspecting, like, you know, what does it actually mean to use those models in a production setting? Right? It's not only about the technology. Contextualizing, like, you know, what are the business use cases? How can we validate these? What are the edge use cases which may not have been factored when the models were trained in the first place? So all those are skills which the model risk managers need to have at this point. And analysts, they have to think about, you know, the various ways in which you can think about the whole workflow from development to production, and then build out frameworks to potentially validate it. So a lot of different skills are coming into the picture in financial services industries now.
Awesome, that's great. So Tulsi, you know, I was an engineer at Facebook in another similar company like Google, and there was no risk management for our models at the time. You know, we would launch models overnight as experiments, right? And obviously things have changed now. And so like at Google, are you, so with responsible AI, are you, how are you influencing the existing ML workflow? How are you introducing the checks and balances to, say, for example, check for bias in models, or, you know, validate them, or, you know, like how is it being, you know, do you have any case studies that you would love to sort of talk about, have any practical examples of your work so far?
Yeah, it's a really good question. And I think the point that was just made about context and making sure that you really understand the end use case of the model, I think is actually really critical, right? And I think this is true across industries. And I think something we're really seeing at Google, which is how a model is deployed in a particular product, who those users actually are, how are they using that model, is a huge part of any sort of risk validation, risk management process, right? And so for us, I think we're being a little bit careful in that sense about how we roll out validation and checks and balances, because I think we really want to make sure that rather than applying a really large hammer and saying, hey, this is the bias evaluation that everyone needs to do, wanting to make sure that the metrics are appropriate to the particular context and to the particular use case, right? So if you have a classifier that's evaluating for spam or abuse or porn, that's a very different use case than a personalized recommender system, right? And how users are going to engage with that, what that's going to mean for the product, what even it means for harm, right, is a big part of the process. And so for us, there's, with all of that being said, kind of taking a step back, what that means then is evaluating at multiple different stages, right? And having different types of conversations. So on one hand, we have our AI principles review process, which we're trying to embed in across the company. And that is really focused on identifying risk and harm. So what is it potentially that the system may do that is positive, right, for users across communities? What might be the potential risks or harms, and what should that mean about how we deploy it, right? So an example of that is text to speech, right? When you talk about text to speech as a concept, great, there are many positive use cases, especially for accessibility purposes. There are also many negative use cases, right, where things can be used for harm. And so thinking through, okay, do we actually want to open source a text to speech model that could be used for any use case? Do we want to be able to deploy that broadly? And then realizing, actually, no, that's not the case. We want to really identify use cases where the context makes sense to us, where the risk reward trade-off is valuable. And then we want to prioritize those use cases, right? Yep. Then that actually leads to something being built. And then you have, as part of TensorFlow and our model platforms, actually the questions about like, okay, now let's actually evaluate the bias of what we've built. Let's evaluate false positive rates or false negative rates. Let's evaluate different metrics around distributional shift, right? Let's understand what these examples are that are errors. Let's make sure the model is robust. Let's build out a model card. And that's when you start seeing us trying to build in those checks and balances in that part of the process and figure out how we build that into the actual model launch process, every time someone is actually launching something out the door. And that's something we're still working on as we build better tools, as we work with more product teams. And so that's something we're hoping to continue to roll out more and more as we better understand these different types of models.
Awesome. So August, when we started Fiddler, we were introduced to this field of MRM, and that's when I learned a lot around all the things that go through the process that banks employ, and the history of it. It was a very fascinating sort of learning experience. So Tulsi touched upon some of the metrics that they look at. From an MRM team's perspective, when a model comes to your team to be validated, and then let's say it goes into production, what are the things that you ensure, to sort of, validate it and also properly monitor it, subsequently when it goes into production?
Right. Thank you. That's very, very good question. Just for some of you that's not familiar with the way regulated industry and bank, such as bank work in terms of MRM, for us, for every 3 model developer, we have 1 independent model validator. They report to different people on the organization change, all the way up to very, very senior, right? To the CEO minus 2, cannot converge. So we have very, very really maintaining the independent, their testing really, really independent. So that's very, very critical in terms of avoiding conflict of interest. So that first. And then from that, the requirement, I think Tulsi touched on this, the model developer and model owner need to be able to articulate not only the use of the model, but how the model will go wrong, be it model will be wrong or model will create unintended consequence. And then from there, we talk about how are we going to measure it? And what is the risk appetite? What is the appetite? How wrong can it be? From that, and that's still challenged by the second line, right? By the validator. And from there, you talk about how the model will be wrong, in what situation the model will be wrong. And then from there, we talk about what can cause the model wrong. Is it the data? Is it the modeling framework? Is it the way we choose train the model? So all of those has to be investigated and quantify in terms of what is the impact to the harm and how acceptable they are. So those who talk about, this is why interpretability is so critical, because that will guide, is this model sound? How is this model will be wrong? Robustness testing is so critical because things will operate in dynamic environment, under adversarial environment. So the focus that in the past, the focus of data scientists that focus on model performance and all the auto ML and all of those things that try to tune to come up with the best model, for us is very, very dangerous to focus on that.
Right.
So you need to look at, just like engineering design, you need to look at failure modes, unintended consequence, safety. So all of those things that need to be tested, not only performance, but how the model will be run. So, and quantification and driving, the understanding the root cause, the driver, and test it and quantification.
Awesome.
I think also, oh, sorry, go ahead.
Yeah, go ahead.
I was just going to say, I think one of the things that I think is really powerful about what you just said too is it's both about the testing as well as identifying the root cause, right? Because I think the other piece that we learned the hard way is that the issues that crop up, whether they're security or fairness or privacy, can occur in any part of that pipeline, right? From data collection and labeling to actual implementation and training to downstream user effects. And so both making sure that your pipeline is robust to be able to have the right metrics to test, but also that you have the right detection methods for where the root causes might be coming from, and abilities to intervene at multiple points, I think matters a lot too.
That's great. So Jacob, I think August touched on this like very critical point, tell me where the model is going to go wrong, right? And it's actually, very hard answer to give, because these models are stochastic models, and more these models, if I'm using, let's say, TensorFlow or any of these AutoML platform, they're like black boxes. What are some of the tools that, or sort of practical ways that banks are employing today to answer that question? How, like, to validate that model, to answer that, where does the model go wrong?
That's a great question, Krishna. And I think Agus described it really well there. So first, it starts with talent, right? Are we hiring those individuals that understand banking, understand how models are actually used? Half of our talent were previously model developers at Region, so that helps. And then that they have that natural curiosity and that willing to challenge authority, willing to challenge executives, willing to say your model's wrong, willing to think creatively and say, I understand this model. An issue we just recently gave, a model was built on a Southeast only data set and it was going to be applied nationally. We were able to test and find that didn't work. Similarly, the model was built only on non-rural zip codes. It was a mortgage model, and it was being applied to borrowers that lived in more rural zip codes. And we gave an issue that it could not be used for rural zip codes. So I think part of it is that creativity to think through where can it go wrong, having the tools to do the testing. We try to embed a lot of our kind of test work into the model development platform. So that helps a lot, but really that developer has that curiosity. Then we give a lot of findings and we spend a lot of time on tracking those findings, really making sure the model developers take it seriously. They remediate them sustainably. And we're very fortunate that we have a lot of board buy-in. So the board of directors cares about this, our executives care about it, obviously our regulatory partners and friends care about it. And so I think that helps too, that this is not just some regulatory exercise. Like, we care about accuracy, we care about fairness, we care about models being used right. And to Agus's point and Tulsi's point and Sri's point, there's a lot of risk that comes from models being used incorrectly. There's losses of revenue, there's operational risk, there's reputational risk, and so forth. So I think it's really important, and all the way from the training to the hiring to the tone at the top, that this is not a compliance exercise. This is not a regulatory exercise. This is an extremely important aspect of the bank. And to Agus's point, more and more banks, modeling and analytics are driving the entire bank.
Yeah, that's a great point. Actually, that indicated there's this whole sort of notion that exists that risk management is a cost center. But to your point, if you actually launch high risk models, it can start to hurt your revenues, and it can actually actually properly risk managing can actually ensure that you can actually maintaining that revenue and increasing it over time. That's a great point. So Sri, from a practical standpoint, a lot of financial industry, accepting some of the well-known banks that are already incorporating machine learning models at big scale, like Wells Fargo. There's still a lot of institutions still on quant models, right? So there are a lot of quant analysts, quant risk managers out there, and they're probably seeing this influx, as August pointed out, this influx of citizen data scientists, this AutoML tools which are generating these machine learning models. So let's say from a quantitative risk analyst, how do they upskill themselves so that they're ready to be able to validate these new models that are coming into their banks, and so that they can, bless them either to be launched or, or whatever sort of guidance that they can give to the
Right.
citizen data scientists.
Yeah, that's an excellent question, Krishna. Everybody wants to have a full-fledged team of PhD data scientists, both for development and for validation within banks. But that's only going to be feasible for some institutions, not for all institutions. And that's the reason why when they look at it from a sourcing perspective, they'll say data scientist would cost me $250,000. An AutoML product would cost me, I don't know, a couple of $1,000s a month. So let's train someone who has been doing traditional things and give them access to a tool which can help them build machine learning models. And that's where the disconnect is, because you will know how to learn using a tool, but you won't have the conceptual grounding. You won't have the understanding of why these models were built in a particular way. And in banks,
right.
It's not about just accuracy. It's not about getting the best model. It is the consequence of something going wrong, right?
Right.
And that consequence is extremely, it's not just tied to the modeling piece. You can't say that this quant model generated X% of errors. My machine learning model was in a particular band, that's okay. I mean, in the Facebook world, if you will, an ad went wrong, you didn't get the click-through rate you were expecting. Well, let's try it better next time. But, if you are denying, credit card loans to a whole segment of population because you trusted an AutoML, methodology and you did not train it properly, you will have the newspapers knocking at your door. You will have customers knocking at your door. There's a huge, aspect which is not just technical, right? And that's something, and that's where we contextualize in our courses, that it's not always about technology, right? So you need to really understand where this, and you're getting too much power with having all these open source tools, and everybody can install it, everybody can run it, everybody can access it, kind of a thing. So that's where you have to contextualize, like, what's the worst thing that could happen to us if you use some of these tools? And the second aspect is, there is always this notion that, the more complicated the tools we use, the more sophisticated and cool tools we use, the better our process is going to be. And I think just a couple of hours ago, we were having this whole discussion about, like, do we really need to go for the denser networks, the ones which use GPUs, the ones which are so sophisticated and just fresh off the press came from the Neuro IPS conference and we have implemented and we are ready to go, kind of thing. It's not that. It's about, like, what's the main purpose of using and building this particular model? Are we constrained with the number of use cases we have that our traditional quant models are not able to suffice? And that's why we are going into these more data-driven modeling techniques. And how are we validating it? Do we have the required knowledge? And that's where algorithmic auditing, not just from a fairness and explainability and understanding perspective, the whole notion about, like, well, can we even use this model for what we were doing or replacing a particular workflow is going to be important. So that's where you had to think about re-educating, not only from a technology perspective, but also from a thinking perspective. How do we think about bringing in these models? And we were talking to another institution, and they were talking about, like, well, many of these institutions do not have the technical know-how. They don't have the technical infrastructure, and they're probably $100 million, $200 million banks. And frankly, they don't really know the difference between a quant model and an AI-driven model and all that aspect, right? And that's where the team has to decide whether it's even feasible for them to adopt AI and machine learning in the current state, or should wait it out. Because if they are not able to, I mean, that's where the whole black box thing comes to, right?
That's right.
I'm not able to explain what's happening. No one's able to explain what's happening. It's not a tech support call to an institution. It's about you making a decision and you owning the decision.
Yep, that's a great point. You touched on two things. One is the algorithmic bias, and then sort of this ability to be able to explain. Tulsi, this whole sort of algorithmic bias has gone in a big time, especially in financial industry. Last year around this time, we have seen the Apple, Goldman Sachs gender bias issues, and some other insurance company getting under some racial bias sort of complaints from users. how do you, like, if you're a machine learning team, how do you assess for bias? What is like a good framework to document it, report it, and sort of I mean, Google has done some work around model cards and all. Could you elaborate on that, and how are you sort of incorporating any use case within Google today?
Yeah, it's a good question, and I think it's a really good point around also. Even the use cases you brought up and the case studies you brought up, because again, coming back to what everything everyone has said about this not just being a technical problem and not just being a single framework, I think that's really been for us the key point. And that's actually why we introduced model cards. So the idea behind model cards as one framework is this idea of transparent reporting, right? And the idea that documentation can actually be a big window into thinking about issues like algorithmic bias, because it starts getting at some of those concerns around explainability, right? So when we ask teams to create model cards, we ask them to document what are the use cases of the model, what are the limitations of the model, who has developed the model, where did the data come from, what does the training data represent, what does the testing data represent, right? How does the model perform across various slices, what are the various metrics and why those metrics, right? And so I think it serves this dual purpose, right? One, it forces the developer themselves or the team to ask themselves these questions, right? Of what are the metrics, why am I measuring these metrics, and how does my model perform across different slices of users or different slices of communities or whatever it is you're looking at. And then it also serves as a launch report in some ways, right? It forces you to also document and report on what you're doing, which also helps any downstream team who might pick up that model and use it either internally or externally. It helps leadership look at the model and understand what they're looking at. And so that we use kind of as this broader framework. And then within the model card, you can say, okay, what are the right metrics to think about fairness, right? So for example, if you have a binary classifier, maybe false positive rates and false negative rates, following notions of equality of opportunity, which is, a theory professed out in academic literature, maybe that makes sense for fairness. In that case, those are the right metrics to embed. But what model cards allows us to do is create something consistent across different types of models, even if the fairness metrics used to evaluate them are different, and at least requires that articulation of what fairness metrics are you using and why.
Got it. Awesome. So August, from a fairness perspective, there is always, at least people talk about this trade-off between accuracy and fairness, and especially in certain high-risk models. How does a bank like Wells Fargo, take this into consideration? Let's say I have created a lending model that's highly accurate, but it has pockets of, populations that it's not, performing well. How do you make those decisions? How do you test for these things, and trade-offs on a regular basis?
Well, in lending space, this is a little bit more very, very established for bank, because we have ECOA, we have regulation, right? We have Reg B that people have to follow. CFPB has a standard, all those things. So lending is relatively very more mature area in terms of requirement and process and testing. So even before what data can be used, cannot be used, it has a whole governance around it. Our compliance people have to approve it. Our legal has to review it. Model development then build it. Model validation independently will be testing it. We have specialized fair lending team that testing those models. For lending, we have specialized team that testing the fairness of model on top of model validation. The testing model itself is challenged independently by model validation too. So for lending, we have a lot of gatekeeper and all very, very established things. The more problematic is more area that's not it's not in lending. So people the broader
right.
side, marketing model that probably not touch lending directly, because product offering sounds very, very innocent, either click or not clicking, but we're dealing with privacy issue and behavior. Cookies information is very discriminatory, it's very demographics. So are we going to do that? We cannot in regulated entity like us. Tech company has more flexibility, like Facebook and Google has more leeway, flexibility on that. Not in regulated environment.
Right.
Even when we talk about voice to text, we do have a lot of voice to text things to serve our customer, to do complaint analysis. Voice to text, certain people with certain accent, including myself, probably will have a lot of amazing voice that translated to text. We have to test all of those. We have to look at that.
That's right.
So it's a lot broader implication and things. And for non-lending area where it's not as regulated as lending, we have to really look at it and say, is this the right things to do? Are we even going to do that given the data? Are we going to even go there? Because it's not the right things to do. So we look at it every step along the way, and multidisciplinary area involved, like legal compliance, model, and reputational risk. So that kind of things that we do.
Yeah, that's awesome. So I
want to build off one.
Yeah, go ahead. Yeah, go ahead.
I'll put up one point from Agus, which is so important. So much of the, I think, conversations, at least with regional banks, to his point, have not been on fair lending, but on fair banking. So one area I think a lot of peers have struggled with is their fraud models, which materially have higher false positives for customers that live in majority minority zip codes. So a customer that lives in a majority minority zip code, so it's more likely to be a minority customer, goes to use their card, say pre-COVID days, let's say in person, and they're a higher chance of being declined when they're using their card for fraud, whether it's at a furniture store or a restaurant or wherever it might be. And we're bringing embarrassment to the customer where their card's declined. And when we work with our fair banking team, that brings a lot of embarrassment to the customer, has a big impact. It brings reputational risk. Is that the type of company we want? So we recognize that while we're trying to help our customers and prevent fraud and send them a text message or decline the card so they don't lose money, we recognize that for many banks, that's more common for minority customers for a variety of reasons. And now the customer is suffering from it. So when we think back about optimizing our fraud models, what are we optimizing for? How are we balancing false positives and false negatives? And how do we recognize that for some groups, the experience of having your card decline is a more painful and a more hurtful experience for some customers than it is for other customers? And so how do we factor in the pain that the customer will experience when being declined in a public setting? Recognizing now the COVID world is our percentage of transaction, their card not present, is higher. So we are rethinking this conversation as transactions are different and it brings less public embarrassment from being declined. And so these are an example of an ongoing dialogue and how even the stay-at-home orders with COVID are impacting how we even think through fraud detection models.
Yeah, that's actually a very good point. In fair banking, which covers use cases beyond lending, marketing, fraud detection, anti-money laundering. So one of the I just touched upon that Apple, Goldman Sachs. The problem was the users within the same household were getting credit limits set by this algorithm that were 10x different. And especially the women were getting penalized compared to the man in the house. So and this could happen for many reasons, right? And is it possible that the model was when it was validated that it was actually a good model from a fairness metrics perspective, but then when it was launched over a period of time, the performance degraded and it sort of became unfair over time? And have you seen such cases in for example, financial industry? How do you handle such things? Maybe Agus or Jacob, anyone of you?
Yeah, I would say this is a very also very sensitive topic, especially when we are dealing with nowadays a lot of natural language processing. Language by nature is very discriminatory. So when we're talking about big language model, especially, do we want to go there? What is the data that we use to train that one? So the non-traditional area like NLP is a full of line mines, and full of things that we have to be very, very careful. So I think that's I want to point that one out because it's so critical for us that we treat people fairly, and for us as well. This deliberation and decision, it's very easy for us to build a model that's very accurate. It's not hard if we can use all the variable and all the data. Right? The key is, no, we don't. We're not going to go there. We're not going to use it. We cannot. It's one thing is for regulation, but I think the other thing is the right thing to do, because once we have reputation, I'll be very frank with you. I am not so much worried about financial model anymore today, right? Because people know,
same here.
Yeah, people know how to manage that. The model is transparent. The non-financial model that create reputational risk. If our model have problem with our model and get picked up by Wall Street Journal and show up, that will be the end of the world. So that's the thing that make me awake at night, right? And for sure, our CEO will be called by the Congress to testify and will be chastised again. We're going to get the new CEO. So that kind of things that we're dealing with. So that's the sensitivity in banking. Yep. That's where we have to live with today.
That's awesome. That's yeah. Go ahead, Jacob.
I 100% agree with Agus, and those are the questions, right? Are minority borrowers, say, on hold with the contact center longer because of our models? Are minority borrowers steered through our, our voice agent towards products that are less desirable? Are minority customers more likely to be steered to different bankers than others? And these are models that are driving this, right? These are our voice agent models, and we call it our customer DNA and our, our voice or, voice of the customer, right? These are trying to make individualized predictions for the customer, for profitability, for service, for next best action. And it's important to really challenge yourself that are diverse customers getting worse service? And to Agus's point, right, if that's in the paper, if that's in the Wall Street Journal, minorities on hold 30 seconds longer, or minorities steered to this product, or more minorities more likely to have their card frozen, or minorities, are less likely to be eligible for a certain account. That's as risky, if not worse, than a lot of the lending, which is already pretty well established in banking for the last 30 years.
That's great.
One of the things to also think about is, when we talk about models used in the financial industry, there's a whole gamut of use cases, right? And one of the big drivers is automation, customer service automation, use of different RPA techniques, trying to automate things which were traditionally done, even marketing workflows which are currently being automated. And Agus was mentioning about users natural language processing, and how do we treat call trees? When someone calls requesting a service, how do you treat that particular call? How do you look at the service level agreements, and who do you prioritize in terms of customer service, and who do you prioritize, what kinds of requests, right? There are so many use cases. And you also have the pressure from, this cost cutting. You want to kind of build out the cost structure in such a way that you entice your customers and retain and grow your customers. There's fintechs coming up with new innovations, which may or may not have all the regulatory structures in place, but they have innovations, the Robinhood trend, if you will, and what can and cannot be done in terms of marketing and what can be pitched to different kinds of customers. So we are in kind of an evolving state of innovation, and different products are coming out, different technologies are making it. I think the whole notion of model risk management is to have that, gating process, and also that arena wherein you can think about what can potentially go wrong and put those constructs in place. And that could go into realization in terms of things which are executable, but things could be in the policy sense, or what does it mean for our organization and how should we think about that, right? So there's a multi-dimensional aspect to it when you think about these aspects.
Yeah, so that's a great point. So I think touching upon that, Tulsi, Google has pioneered this whole NLP models. Obviously BERT is one of the state of the art. It's now powering search. How do you monitor these BERT models, based on all the things that you've heard, from a fairness perspective, a performance perspective, so that, let's say it's not so showing only certain kind of results for a certain kind of demographic or whatnot today?
Yeah, I mean, we've done a lot of work kind of across the board. I think what's really interesting about these NLP models too is how they're used because they power many different applications in different contexts, making sure that we measure at the end context, right? So for example, when we released BERT into search, we did a lot of very detailed testing, right? To make sure that we're evaluating different types of slices, different types of performance failures. I think Agus brought up, different languages or accents, right? And the way that might actually play out in a system, right? Making sure that we're looking at those different types of areas. And so there's both evaluating BERT as a system on its own, right? And we are doing a whole bunch of research and trying to continue to publish research on how to improve BERT by itself, but also in the downstream applications, right? How do we slice and evaluate that? I think the other thing that's important to call out, and it made me think of this when everyone else was talking about the Wall Street Journal and some of the public press, but also I think your original question about the Goldman Sachs card, is that even with validation, right? Even when we evaluate these overall slices and metrics, that doesn't actually mean we're not going to see a mistake like the one that Apple saw, right? I don't know what validation they did or did not do. But even when you're looking at error rates and you're saying, hey, across these slices, my system seems to be making the same percentage of errors, that does not mean you won't see an example of two people in the same household who see a different experience for a variety of reasons, right? That could be a fairness failure. That could also be a robustness failure of that moment. That could also be biases that you didn't account for, right? Like different types of speech or other types of components. And so I think it's also important for us to acknowledge that even the most validation that we do, we also have to put the right guardrails in place, because we don't know what kinds of errors we're going to see that we didn't originally think about, or that represent metrics that we didn't have.
Yep. Yeah, and I think this is where we believe that continuous monitoring of these models in production is going to be very important. So, monitoring also got into picture, especially with coronavirus. One of the things that we observed is because of COVID-19, everything changed, right? And user behavior changed, employment changed, like the social constructs, the world reality has changed. So how has it affected, banking, from a model, performance perspective? Have you seen, any, weird nuances? Yeah, maybe Jacob, anyone, yeah.
Yeah, I'll give one little example. So one great example, I think, is back on the fraud models. So at Regions, our fraud models that predict default transaction, that predict fraud on a transaction for debit cards or credit cards. And the most predictive variable is card present versus card not present. So historically, we expected that you would use most of your transactions as card present, and all of a sudden your transactions became card not present. We thought it was fraud, of course. So of course, when COVID-19 hit, even before state orders, we were seeing in late February and early March material changes of card not present in some of more of our urban zip codes. And as we went more into our rural zip codes in mid and late March, you're seeing all of a sudden that customers are now using their card online for purchases online. So now what happens? The fraud investigators are overwhelmed with all these false positives, all these cases of fraud. But what happened? No, the customer behavior changed. The customers materially curtailed their shopping externally with card present and transitioned dramatically to online shopping. Even my mother, who's 79 years old right now, she bought shoes online for the first time on COVID. And sure enough, she got her card frozen, and she got a text message and this whole thing. And she thought her card was frozen, and she called her call stolen. She called me. She thought it was me buying shoes for her. A whole long story. But there's that's one of the first issues of model performance deterioration we saw in fraud. Later on, capital markets. Now we're seeing it finally showing up in the credit just here in Q4 for us. But yeah, so fraud was the first one for us.
Let me say this one. I think we at least for us, we managed the model risk during COVID-19 very, very well. And why is that? Well, one of the key important things is we understand the model. The model is very transparent, very interpretable. So this is why it's so important in terms of conceptual soundness of the model. This is what one part of my criticism that we talk about. Today, we make machine learning available to anybody. Somebody that can use TensorFlow, somebody that can use scikit-learn, they think they can build model. Do they know the danger? I pick an example, deep learning, and I wrote a paper on this on the deep ReLU networks. Deep ReLU network, in traditional model, we have a few regression equations that we know exactly what those regression equation is. You put deep ReLU networks, suddenly you're dealing with 100,000 or 1,000,000 linear equation. You can decompose it into local linear equation. I wrote a paper on this one. Are you sure you can manage 100,000 or 1,000,000 local linear equation? So that's the type of things that we don't do. We look at it, okay, we're dealing with the beast. We're dealing with deep learning, we're dealing with the beast. But how to control the beast, how to tame the beast, so that when model fail, we know how safe, we know how the model will fail and how to deal with it. So that is very, very important, which kind of, I'm very, very concerned, because the vendor and the hype out there. Okay, you use this, you get good model without knowing how to control the beast.
Yep. That's a great point. One of the customers that we are working with, jokingly said that, in the past there are all these, regression artists, carefully created these quant models. Now everyone is a citizen data scientist in their organization, and there are thousands of them creating models, and they're just getting inundated to, validate them these days. So it's a very interesting point. So I think we have a few minutes left. I wanted to throw it into you all, and you can go in any order. Where do you see this space going in the next 2 to 5 years? What is, and obviously, there's this explosion of new modeling algorithms that are coming up, BERT, GPT, and whatnot, and the models are actually becoming more and more complex, and then that's putting pressure on monitoring and validation perspective. And so there's obviously a balance that one needs to strike here. But where do you see this field in the next like 5 years going, to make sure that organizations are still benefiting from this technology, but doing it in a careful manner? Maybe starting with Sri.
Yeah. So 5 years ago, if my students could write a Jupyter notebook with Python, they would get a job as a data scientist. Now, today, they are being asked to talk about how do you productionize code? How do you do model inference? How do you think about scaling these models? How do you think about version control? How do you think about making it, looking at all the aspects which are ready for production? And I think, when you look at the statistics, even though you hear a lot of buzz about all the cool things out there, very few models are actually making it into production, especially the AI and machine learning models.
That's right.
So there are only 5 to 10, 15, 20% of the modeling effort which has been spent is actually getting into production. Most of it is in this digital playground. People are exploring, trying to figure out what's actually happening. And that's important because, no one wants to be left behind and everybody thinking like, okay, we could have gone to this route. I think the production story is going to start getting consolidated, and people are going to start talking about established processes and how you could deploy these things, scale these things. And also some of the noise is going to subside, especially what happened with the whole big data phenomenon, right? Remember big data 5 years ago? Everybody wanted to be a big data analyst. Everybody wanted to get in Hadoop. That's going to happen. Some of the limitations are going to be so clear that you will know that, I can go for a simpler approach rather than trying to throw all this machinery at it. But there are also going to be some cool new innovations and ways in which you can access it, because access was a big concern. How do you bring it in? And with COVID-19, one thing has happened is everybody is thrown to the cloud. There was this reluctance of moving things from on-prem to the cloud. So everybody is thrown into the cloud. Everybody is thinking about remote working, remote access to various resources. So I think that ecosystem is going to start growing. I'll primarily touch upon the technology aspects, but I think those are some of the things I think is going to happen.
Great. Jacob, do you want to follow up on that?
One thing that we talk about a lot about the bank is kind of like a license to build models, right? You drive a car and you have a driver's license. And so just considering all the risks, we could just rely on other controls, detective controls, but that's like, okay, we can let 12-year-olds drive cars and just put more police officers on the road to pull them over, or no, we should have more tests. So one thing we're exploring is that and I know we've learned this from a Goose because he taught me a lot on kind of the quant council, but we're thinking of maybe all model developers have to start in model risk for their first 6 months. And they work and we're good, we have a comparative advantage. We're good at using people that are fresh out of grad school. Some of the other model development teams struggle with utilizing people that have them valuable until year 2. And so we have that comparative advantage. And then when they go to their team, their permanent team on month 7, so even if it's not a full rotation, just 6 months with us and then permanent team, they'll be more trained, they'll be more qualified, they'll know more aspects of the bank because they'll touch all sorts of models. They'll have a strong understanding on fairness, strong understanding of everything we've talked about on model risk, on model validation. So that's one thing I think is that more and more banks are going to say, so I want to take this person, even if they have 20 years experience or 0 days experience, and just throw them on day 1 on a model. I don't know. So I think we might start maybe effective January 2022, any new quant that's hired will do 6 months with us and then go develop models.
That's actually a very interesting strategy. Back in the day when, Microsoft used to ship box software, the new grads were start on this test engineering team first, and then sort of, graduate themselves to be developers, before they ship code, they first test code. So it's kind of, very similar sort of strategy that they employ. So Tulsi, do you want to follow up, especially on like, where do you see this responsible AI? Do you need like regulation to sort of, do you think regulations will come, and how do you think it's going to affect?
Yeah, it's a really good question, actually, and very much read my mind, because that's exactly kind of where I was thinking about it over the next 3 to 5 years. I think we're already seeing, white papers coming from the EU. We're seeing, some amount of movement in the US as well. We're seeing movement in Singapore, right? There's momentum kind of globally to think about what does it look like for us to regulate AI. And I think there's some things that we're hearing around especially transparency and explainability and interpretability. And so I think over the next 5 years, we're going to see more and more documentation come out, more and more proposed regulation come out that articulates this and is going to lead to more within all of our industries around actually putting in proper processes around transparency, around explainability, around interpretability, so that we can actually justify that regulation. And I think that'll tie back into both what Jacob and Sri said, right? Because we're going to need those processes. We're going to need individuals who really understand risk management. We need all of our developers to start building that. And it's probably going to lead even to a shift in computer science education, right? In colleges and institutions. And so those who are coming out with degrees hopefully are going to have and start building more training in risk management and explainability as well.
Yeah, and then finally, August, do you want to put any closing comments? Where do you see this field going in the next 5 years?
Yeah,
and not just in banking, but overall as well.
I think if you look back, the other parallel, in product design, people, they have the discipline of reliability engineer and safety engineer, right? In software, you have it as well. Now we're dealing with something that more like it's a software, but it's a like product. It's stochastic. So the discipline that we learn from that has to be there. Now we're dealing with the complexity that we're dealing now is the speed and the scale. That the cycle or life cycle of model is faster and the bigger and more complex model. So what is the tool that we can equip people to do safety and reliability testing? Today, that is a very early inception. People talking about counterfactual testing, about robustness testing, but it's like it's still in the academic world. It's very nice sounds. You put it in real world to do this thing. It's not scalable. And we're dealing with the bigger and bigger model, how to test reliably. And we know we're dealing with the rare event of failure. How can we find that? So I think not only to teach the people to do this, to be reliability engineer, to be safety engineer, but what are the tools that will enable us to operate at speed and scale to find potential failure, unintended consequence way ahead of time before we deploy model, and the monitoring too. Monitoring is somewhat passive today, but monitoring cannot be passive anymore. You have to continually testing, coming up with scenario, anticipatory to do testing, not only based on the data that you observe.
Yep, that's a great point. You mentioned what is the tool to do this, and hopefully Fiddler will be the tool. That's the reason why we started the company, and I think that's a great way to end this conversation. Thank you so much for coming to this panel and participating and sharing your valuable thoughts. And that's it. Have a nice day, rest of you all.
Thank you.
Bye.
Bye.